Physicians probably pay the most in taxes of any professional out there. Orthopedic surgery colleagues that reach out to me all the time, and they're like, dude, how do I minimize my taxes? I'm paying $750,000 in taxes, $550,000 in taxes a year.
Having those conversations, it's not, okay, I need to save so much in S&P 500 stock. It's more about how do I plan for efficient tax strategies, getting that income number a little bit lower, whether that's tax deductions or different stuff. And then, the self-directed IRA can be a tool in that tool belt. I always refer to it that way.
Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stevenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who've stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. All right, welcome back to the Doctors Investor Club podcast. Today's guest is someone who has helped thousands of professionals shift from Wall Street dependent investing to true tax advantaged wealth building. Matt Calhoun is a senior leader and educator at Equity Trust Company, one of the nation's largest custodians for self-directed IRAs and 401ks, helping investors deploy over $40 billion into alternative assets like real estate, private equity, notes, crypto, and more. Matt has a background in economics, finance, education, and business development, and he's become a trusted voice for entrepreneurs and physicians wanting more control over their wealth. Matt, welcome to the show, sir.
Thanks, Kyle. I really appreciate you having me.
Yes, absolutely. No, we're excited. Yeah, we met in September, I think it was, at the Investor Summit in Beverly Hills, and we connected a couple more times after that. But yeah, you're fantastic. You're a wealth of knowledge, which we love. Your partner did a good job. He spoke on stage a couple times. Yeah. And I think you guys were brilliant. So this is going to be great for physicians. I think it's one of those that's misunderstood. I would tell you, for me personally, it's a misunderstood topic. And so let's dive into it. First of all, just give us your background a little bit, if you don't mind, how you got into it, and where'd you come from, all that.
Yeah, so I started kind of more a traditional path of like in financial services. So did kind of the advising route, learned stocks, bonds, mutual funds, different things. They're the basics. And then kind of ironically, the guy who was mentoring me, kind of managing at the time, I was like, as you start learning the ropes here in financial services, he's like, you should just start buying some rentals. He's like, that's what I do. That's kind of my side thing. Like, invest in the market, but like buy a couple rentals. I'm like, all right, sounds good. Like, I kind of look into it. So me and my wife now, but girlfriend at the time, started looking at house hacking, some duplexes, started there, did a few more times. And when you're in the real estate space, it's kind of weird to I lost the passion really for the traditional markets. Like, I knew this other thing kind of existed, and they don't teach that in most of your traditional financial services spots, kind of like the other, we're really focused on stocks, bonds, mutual funds. Real estate's kind of this other thing you just don't know about. And when you kind of get the itch, it's hard to kind of continue recommending people put their money in the S&P, and blindly kind of look at that only. So that's kind of how I started looking at alternatives. I really did like the real estate space, and then kind of learned about the self-directing thing. It really hadn't gotten too much traction. I've been now doing it for like 10 years, almost a little less than 10 years. And at the time though, maybe there might have been like a podcast or two that kind of mentioned it, but it really wasn't as, known now as it is, I guess, now to the most investors. So knew of this local company that kind of did some 1031s, that did the IRA space, and like, hey, whatever you can kind of fit. This is kind of my background. I know the retirement accounts and how those are leveraged for benefits, but how to like include real estate, is not taught. I've been licensed with different states or anything else. It's not even taught at all. And this is kind of like a new world. It really did open up a new world. It's kind of, I can buy real estate, rental properties, private equity, private debt, different asset classes, all in retirement accounts, keep those tax benefits. Kind of got rolling from there, and different roles within the company, but really learned the space really well.
I love that. And, this podcast, we do talk a lot about real estate. We talk about cash value, whole life insurance. We talk about this is one topic, actually, self-directed IRAs we have not gotten into yet. And so this is awesome that we're getting to get into it. But I talk to physicians all the time about real estate. I have a presentation that I give to medical students, and I'm about to go to our local medical school here next month and give a talk. And it's really just like an unbiased opinion of wealth and how the wealthy are doing things, right? And so one of my slides is, here's how the middle class thinks, here's their asset allocation, here's how the wealthy think, here's their asset allocation. And it's like, don't you think we should be doing more of what they're doing? They're obviously figuring something out. There's tax benefits and they have control over their life. And so with that being said, the middle class mindset is put 80 to 90% of your money into stock portfolio and just let it ride for 30 years and then retire and draw it down. Whereas the wealthy don't do that. They have like 30% in the stocks. And so give us a little bit of a breakdown on why do you think real estate is powerful? You go to these big meetings where there's tons of wealthy people that are doing real estate. So just give us a little tiny breakdown of why do you think real estate is a good investment and why you think maybe doctors and dentists should look a little bit more into it.
The leverage part is really big with real estate. It's one of the things that's pretty unique to the asset class that, like when I got started for house hacking, I could put down a 3% on a loan and purchase an asset that was worth, a lot more than that. And then as you don't, FHA or anything like that, you still can get 20, 30% down in finance. That is pretty unique to that asset class, where I can't do that and go buy a bunch of stocks. Like, you can start to leverage it, but that is a nice thing to get started. I guess there's kind of different levels of entry into real estate. But yeah, the tax advantages are huge. Being able to depreciate these assets, and the tax code is just built for real estate. There's just so many things that you can do to mitigate those taxes if you're a high net worth individual. The other benefit is just long-term sustained growth. We've talked about brick and mortar asset, hard asset owning, always having the asset kind of appreciate over time, being able to do that as well. Huge wealth building tool there. So that's one reason I really enjoy real estate. It's something you can kind of get your hands dirty on and kind of improve it yourself. Like, if I'm just a shareholder in a stock,
right,
I can't do anything. I have a vote, a proxy vote, something there, but I can't really affect the company and immediately make the value change. But in real estate, you can do that. You can actually do things that overnight can make your equity better in the property. So that's something that always attracted to me to real estate. I think it does attract a lot of investors to real estate as well.
Yeah, because you have leverage, not only leverage on the property itself, like you can put 20% down, or, in your case, 3% down the first time. And then the bank's paying 80%. So that's leverage, which is stock. If you put $10,000 down, you get $10,000 worth of stock. You put $10,000 worth, on the house, then you're getting a $50,000 house. So that's the difference. That's the leverage. But the other thing is leverage on the tax benefit, as you're talking about. There is leverage with that. So, using the cost segregation and all that stuff, right? The cost seg studies to get that depreciation, that bonus depreciation, that's leverage as well.
Yeah, definitely. Yeah. It's a powerful asset class, and just being able to use it in your wealth building can help a lot. Help me personally. Everybody, everyone I talk to, has a story about how their life kind of changed by buying real estate or buying certain assets.
Yep. And the biggest thing I think people need to understand is, it's definitely not get rich overnight. I mean, it's a wealth building tool that you mentioned. Yeah. And so that's a slow, long-term play. It's compounding interest, that compounds on itself, but it takes time. And so you got to be patient with it.
Yeah.
All right, let's get into, a lot of doctors have, 401ks, IRAs, all that. And docs may even think like, hey, I want to get into real estate. I just don't have any extra money lying around. What are some good ways that they could potentially invest in something with IRAs, 401ks? Let's just get into the basics of it all.
Yeah. I always say something kind of surprises people, especially if you've never heard of self-directed IRAs before. Because always that's the first question I got: what's a self-directed IRA? I always tell people it's actually a really good marketing term that doesn't mean anything. The self-directed IRA that we set up is the same IRA that you could open up at Schwab, Fidelity, or other brokers. So in the 70s, when IRAs were started, the U.S. government made it 401ks, traditional IRAs were open at that time. There were no restrictions on the asset classes. I mean, there are a couple of restrictions, but it didn't say you had to invest in Wall Street products, publicly market securities in retirement accounts. Basically, you could open up in this retirement account and hold real estate, private equity, private debt, all these other investment types were allowed. But the companies who immediately started offering IRA accounts, 401k accounts, they already sold stocks, bonds, and mutual funds. So they just continue to do that. And then as a country, we kind of just decided that's what you do in retirement accounts. Equity trust did actually start 50 years ago, which is about the same time IRAs became available. And one of the first investments in that retirement account was like a real estate syndication. It wasn't even called a syndication at the time, but it was a couple people just pulling some funds together to purchase an apartment building. So we kind of took a divergent path, and there are other groups too, and they hold private assets or different assets that are just not your traditional stocks, bonds, mutual funds. And that's what we're talking about when we're referring to self-directed IRAs. It's a same retirement account as far as the U.S. government concerned, the tax code is concerned. It's just a custodian that lets you hold different asset classes that most people just don't even look at. They think investment means publicly traded stocks, bonds, mutual funds, but there's all kinds of other asset classes that you can hold in those retirement accounts. So it kind of opens up the world of investing possibilities when you think, okay, I don't have to just be in there. If I want to buy that real estate property and maybe my money outside my retirement accounts is tied up, I can actually use that retirement account and purchase a property, invest in a real estate syndication, invest in someone's startup. It just opens up the investing possibilities that you have.
That's amazing, man. The wheels are turning. I'm just thinking, I was giving my medical student a talk the other day, just her and I were just chatting. And I was like, the wealthy are using that same dollar multiple times, right? Whereas, again, the middle class, and I put doctors in that middle class mindset because most are, because we just don't get any financial education. But, it's similar to like an asset line of credit where you have, your line of credit against your stock portfolio, or a cash value whole life insurance. Your cash value is basically collateral against or a loan against your death benefit. This is an IRA. So you have money in your retirement account, and then you can borrow. You're not borrowing that money. You're actually taking that money, but otherwise it's just sitting in a stock portfolio untouched, right? You're just going to let it sit until retirement. So it's basically just investing it in real estate, or you could keep it in the stocks. But is it for self-directed? Are you mostly using that for alternative investments?
Correct. Yep, correct. So the same way that your money is in your traditional IRA and you purchase shares of a company, the money is in a self-directed account, and then you're purchasing ownership in this property or purchasing ownership in the investments.
Yep.
You can still leverage that dollar. So you can still take out a loan within the retirement account, separate from yourself personally. So that's something we always get into. So you still have the same benefits there. You could use the big thing people, first of all, it's access to capital. So as you would assume, most people in medical professional, they make pretty good livings. Like they've saved money in retirement accounts. They have this pool that they've built up. They've invested in the market. Some of that can now be what I call truly diversified. So not just diversified across the S&P. You can actually get into other alternative asset classes and really diversify their retirement accounts. But use those dollars to get into investments that maybe will actually get a better return, but also investments they may know better, have an expertise in, or know somebody who does. And that's really the powerful tool. And you get the same tax benefits. So you're still deferring those taxes on the investments you make the same way you would traditionally using retirement funds.
Yep. So, okay, with that being said, 401k is obviously you're not taxed on it now. You'll be taxed on it when you take it out in the future. A Roth IRA, it's post-income tax, so you're never going to be taxed on that again. Can you take your Roth IRA and convert that into self-directed, and then you're no longer going to be taxed on that money?
Yeah. So we have Roth self-directed accounts as well. So the 401k, depending on the employer you're with, sometimes have different buckets. Most funds are pre-tax 401k. So that's money you've never been taxed on. When that money does come out, it's taxed. Now, some 401k plans do have Roth buckets. So they'll actually have after-tax 401k, and that works the same way. It grows tax deferred, but then when you pull that money out, it's tax-free. Roth IRAs work the same way. So while you're investing, you buy a rental property, you sell it, you make a bunch of money, no taxes. You invest in a company, it does really well, no taxes. With Roth, you pull that money out in retirement, still no taxes.
Yeah.
Traditionally, you pay it on your tax bracket at the time, and just of what you pulled out.
Yep. Real quick, as we're talking about, can you clarify the traditional IRA? So I know once you make, I think it's over 150,000. Now you have to put money into a traditional IRA, but then you can backdoor it into a Roth, right?
Correct.
So then so you pay the taxes on the front end still, right? Explain that to me.
Yeah. So because Roth is such a good deal getting that tax free, there are income limits on it. And you're correct. It changes a little bit each year. But what that just essentially says is once you've hit this income limit, you can't directly contribute to a Roth IRA. Now, you can contribute to a Roth 401k if that is offered through your employer. But if you have to go to a Roth IRA, you can't directly contribute. So then what you do to get money into a Roth is you contribute to the traditional IRA. You get a little bit of a tax benefit now, possibly on the contribution, but then you're going to convert. You're going to pay the taxes on that money, convert it to a Roth IRA. There's some rules about how long you need to keep it in there, but then you would have that as a tax-free benefit as well. And something I always think is important is just having buckets of when I'm thinking about the previous world of financial planning, like being tax efficient with how I'm going to pull money out in retirement, or I'm already pulling money out. Like I'll have my tax-free bucket, I'll have my deferred tax, and I have my outside retirement account funds. And just being able to pull from those different levers in retirement is a powerful thing as well. One thing the wealthy does really well is they're tax efficient. People don't realize taxes is one of their largest expenses, and it's part of everything that we do. Being able to be tax efficient in pre-retirement and then retirement is a big wealth changer.
Mm-hmm. Yep. If you think of an income statement, if you're running a business, you have your revenue on top, you have your expenses, and your largest expense is your tax. So what are ways that you can minimize your largest expense? That's basically what you're doing in your own personal life. So tax efficient. This is not like, oh, we're paying $0 in tax. It's like you're going to be paying taxes forever, of course. Even the wealthy do. But how can you be the most tax efficient? And I think one exercise I actually just did recently, and I think it's pretty powerful, is so my dad passed last year, almost a year ago now, and he was always the financial guy in the family, and we always went to him for advice, and he ran a business for a long time. And so his last 6 months, I was picking his brain on all this stuff. Like I've been studying this stuff for years, and I was just trying to figure it out. And so what better way than somebody that's, at the latter aspect, like they've done the whole retirement, done the whole invest to retirement, and now they're living in retirement. So I'd pick his brain, figure things out. Well, now my mom's trying to handle that stuff, so I can come and help her. And so I've been going through her account and just seeing, all right, you have this is traditional IRA, this is 401k, this is Roth IRA. So figuring out now like how she can use those and what's going to be taxed, what's not. It's just a really cool, like powerful thing for me to see, just to like almost get the future. And that's what the wealthy do, right? Like they're not just thinking about the now, and they're definitely not like blind to it. They're totally planning for the future, and not even just their retirement. They're planning for the next generation and the generation to follow.
Yeah, definitely. Like you said, they're planning for pre-retirement, retirement, and then how do we efficiently pass this along to the next generations as well? And I would say Uncle Sam's going to partner with you at some point in this. It's just a matter of how much of a cut does the U.S. government have to get in the taxes? So you try to eliminate how much that is.
Yep. Do you work with a fair amount of physicians, dentists?
We do, yeah. So because those tend to be occupations that have larger account balances for retirement accounts, it's a pretty popular, group that self-directs. Plus, also they get a good networking effect. So they have people who start businesses. We actually have, like you said, dentists. We have a group who's basically starting a franchise of chains, and they're investing with their retirement accounts to like kind of get that off the floor. We see medical technology. So if you're a doctor, you probably ran into a group of starting up. We have a new medical equipment company we're starting. That'd be a good one to invest in. People use that retirement account. So yeah, we definitely see a lot in that occupation. It just makes sense for that, whether real estate to help with tax burdens or, like I said, some startup businesses as well.
Yeah. If you think about it, the highest paid professional is basically, professional athlete, NBA and NFL, all those guys. And they're the top like 0.1%. They're elite athletes, and they get no financial backing. I think 80% of them go broke when they get out of it. But then physicians are always at the top there of highest paid professional. So that doesn't mean that, there's plenty of wealthy that make way more than us, but they're business owners. And those business owners pay way less taxes than physicians. So when I think about it that way, physicians probably pay the most in taxes of any professional out there.
Over the course of their life, yeah. It's got to be there. Yeah, they got to be up there pretty high.
Yeah, and I have, orthopedic surgery colleagues that reach out to me all the time. And they're like, dude, how do I minimize my taxes? I'm paying $750,000 in taxes, $550,000 in taxes a year.
Yeah.
And they just feel stuck because they have their financial advisor who doesn't really know. He's like, I've heard about real estate, but I don't really know much about it. I've heard about IRA, self-directed IRAs, but I don't know much about it. So I think that's why this episode is going to be so good, just to get people to open their eyes and be like, hey, I can reach out to Equity Trust and I don't just have to have my one advisor giving me all the things, because they're obviously a little biased towards keeping money with them.
Yeah, we run into all the time where it's hard to find a financial advisor who's seen it all and has a holistic approach. Normally they have their suite of products they can sell, and if it doesn't fit within that box, they don't really know what to do. So it's hard to find advisors that can kind of look ahead and kind of know that. So yeah, if you find one, they're worth their weight in gold. It's a great thing. But yeah, it's having those conversations. It's not, okay, I need to save so much into this S&P 500 stock. It's more about, how do I plan for efficient tax strategies, getting that income number a little bit lower, whether that's tax deductions or different stuff. And then yeah, the self-directed IRA can be a tool in that tool belt. I always refer to it that way. Is in your whole investing approach, we're a piece of it, but it's a tool that can be used in the right situation.
How do CPAs like this approach? I've talked to my own personal CPA, and I've been investing in real estate now for 5-6 years, and he's never loved it. He's like, well, there's more risk in real estate, so if you're going to use your retirement account to invest, I would just keep it in the market where it's been going up for 40, 80, 100 years. So yeah, how's that relationship with CPAs mostly for you guys?
Yeah, I mean, it's going to depend on the CPA. Some have the personal thoughts on where that goes. Ones that are real estate more centric, obviously they use it a lot. They do like it. They find it a good way for clients again. But I will say they don't recommend it to someone who doesn't know. They wouldn't say, hey, you should go buy rental properties if you have no interest in knowing how to underwrite your own rental properties or anything else. But that doesn't mean you can't go invest with somebody else at that point too. So you can still get exposure to certain asset classes without being the expert yourself. If you are the expert, then it's a no-brainer. But then it's about finding, okay, if I'm not going to be the one that knows what investments to pick, like who do I find that can I get exposure to that asset class that hopefully will beat the S&P or beat the market as a whole. But then I'm leveraging someone else's expertise. It actually really works out for the physician's analogy. I say, sometimes you can be the general practitioner, but for certain things, you kind of want the specialization. You want the surgeon to be involved here. Sometimes you got to hire that surgeon to go manage your money or go get that return that you want in that retirement account.
Yep. I think the thing that makes the most sense for me, like I am general partner on real estate deals. But for most physicians that we're speaking to, they don't want to do anything with that. They don't want to deal with being GP. They don't want to be the landlord. And so most of them will invest as an LP in a real estate syndication, to your point. Is that where you see this the most common?
Depends. I mean, personally, yes, for me. But as a whole of the industry, we do see a lot of people who do want to buy their own rental properties with this. I don't know what the actual percentages are, but yeah, our division of the company, that's what we specialize in, is people who want to be LPs, invest in other people's deals, and kind of be a little more passive on it. But you don't have to be. If you do think you're that person who has time that you can manage and get the best return, you can do that as well. But yeah, our division specializes in those groups who want to invest passively.
That's great.
Motion light.
I saw that. That's all good. Good deal. I mean, what are some big like aha moments for docs or dentists that hop into this? And yeah, what are just like general aha moments where people are like, oh, I didn't even think about that. I didn't even have a clue that this was a possibility. Maybe the biggest is it just opens up capital that you otherwise didn't even think about.
It's always the first one, I would say, is access to this capital. It's a way to get into deals that, like I said, maybe you didn't have the ability to get into them otherwise. It really lines up really well with long-term deals. So we talked about how real estate's not an overnight wealth story, and a lot of times alternative assets are that way. If you're investing in a new company, it may take a long time. That always fits really well with the retirement account timeline. It's hard to commit money from your personal checking your savings account when okay, it may take 10 years for me to get this, 5-10 years before I get this return. But if I'm not retiring for 5 or 10 more years, that's perfect. Then that lines up really well with that investment timeline. So not only the access to capital, it tends to line up really well with the timeline for those dollars that I need. But speaking to physicians, I always say that a conversion can be pretty powerful as well. And if you're not a W-2, if you actually own your own practice or sometimes an individual 401k or defined benefit plans, other retirement account options open up to you. And a lot of times those can be self-directed as well. So you don't have to think that, I can only put so much in a traditional or Roth IRA. There are sole 401k plans where people convert every year everything they put into their 401k to a Roth 401k and then invest there. I mean, we're talking putting $70,000 a year into a tax-free bucket, letting that grow over time, compounding. That's a pretty powerful wealth tool that can be tax-free as well. And if you still have a pretty high tax burden in retirement, that tax-free bucket helps a lot. That you don't have to continue to pull money out of that tax-deferred account and increase your tax burden. So that for the right person, being able to convert inside your 401k or anything else to Roth is a big deal.
Explain this to me. So, we've always been taught you put money in your 401k because it's pre-tax, so you won't be taxed on it now, which you're in the highest tax bracket you'll probably ever be, and then you retire and you'll be in a lower tax bracket, and that's when you're going to pull the money. And my argument to that is, right now it's only $20,000, but in 20, 30 years from now, that could be worth, $200,000. So you're now taxed on a bigger number. So that's a problem. And then the tax brackets only go up. Like, our taxes aren't going to go down. They're only going to go up more than likely. And then the third thing is the value of the dollar is stronger today than it will likely be in 30 years. So those are some of my arguments against the 401k.
Yeah.
But my father-in-law is retired now, and he's not pulling out money on the 401k yet because he's still in a certain tax bracket that's not zero. But my question is, say you have no job and you're retired, what is giving you, what is putting you in a certain tax bracket at that time? Like, what income is that? Is it dividends?
It has to be earned income. So, that's where that would kind of factor in.
Right.
Yeah. The consensus on, you'll be in a lower bracket in the future is kind of tough. Like, if if you can predict the future, great. Then that makes financial planning very easy if you can predict the future. But you don't know that for sure. I mean, you could end up being, like you said, we have a big national debt, probably could see rates increasing across the board there too. But yeah, you would want to keep, and that's actually an argument for outside of your retirement account, doing some real estate as well and keeping that taxable income low. So that way, when you're pulling out of your retirement accounts, you may pay less on taxes in that option as well. So yeah, it's definitely always an option. And then you can kind of play with it. If you are not maybe in the highest bracket for a certain year, you can always convert enough to get yourself right below that next bracket. This is a great time of year where at the end of the year, you're pretty close to knowing what you're going to make for the year. You can kind of play that game and see, okay, do I want to convert a little bit more to Roth now to basically max out my bracket without going into the next tax bracket? So those are some things you can do now to help get a little more money in that tax-free bucket.
Yeah, that's great. I mean, you bring up a good point on that. Like, last couple of years, just getting into real estate more, I've become more proactive with my CPA, and now I talk to him all the time. I mean, at least a couple of times a month. Whereas before, it was just, March, right before tax season, you send all your stuff and let him do your taxes, basically. Well, now it's like, no, we're strategizing for the next year, right? And so, with that being said, I think people listening to this, doctors, dentists, any other professionals, you got to be proactive. And your CPA might not, they may not just come to you, or your financial advisor may not just come to you and say, you should be doing this. Like, you got to be proactive, and you got to understand how this all works. So even with these self-directed IRAs or your retirement accounts in general, like, understand that's access to more capital. There's, potential for more benefits. So it's really understanding the big picture, being proactive in your own wealth, because only you personally have as much care in your wealth and more than anybody else, right? Like, you're the only one that's going to treat it like your baby. Everybody else is kind of making money off you to a degree.
Sure.
So, I think you brought up a good point. Just, now's the time. December is the time to really start thinking about this stuff, being proactive with it.
I say, yeah, there's some stuff you can do throughout the year, but it's really nice to kind of know in December. I have a pretty good idea what the rest of the year looked like. So I can kind of maximize what time I do have at the end of the year. And yeah, to your point, I mean, there are CPOs who are glorified bookkeepers. Essentially, they kind of just put stuff in, but like you find one who is really good, can provide strategy and get you thinking about the whole picture. Like I said, normally we are just a piece in the picture. The alternative wealthy people have a portion of their assets attributed to this, but they have other guys and they have specialty people involved in different parts of their wealth building.
Yeah. Yeah. You guys are one piece of the family office, basically, right?
Yeah, that's the thought. Yeah, exactly.
So, with that being said, what are some other investments that you could do, like alternative investments besides real estate, that you guys would encourage?
Yeah. So I'll say we don't encourage. We
okay.
we administer. Okay. I gotta keep the compliance stuff off my back there. But what we do typically see. So I kind of mentioned earlier when IRAs were starting in the 70s, what you couldn't invest in. So there actually are a couple asset classes you can't hold in a retirement account. It's life insurance and collectibles. So life insurance already has the tax benefit, included with the death benefit and everything else. It's kind of redundant. So that's kind of the reasoning behind it not being allowed in a retirement account. Collectibles are really defined as antiques, coin collections, but only really if it's the collector value in it. Not quite sure, other than it's just kind of hard to value those assets. So those can't be held in a retirement account. And that's it. So that's the only thing that's kind of said you cannot hold in a retirement account. Kind of opens this up to a lot of different things. I mean, doing this for long enough, it's a lot of real estate centered investments. Lending is very popular. And I always recommend lending because there's no tax benefits for lending. It's not like real estate where you can depreciate assets. And you don't get that when you lend money out. But if you do in a retirement account, it's tax deferred or tax free in that account. But we'll see, private equity. So buying into a private equity fund, but also starting, I shouldn't say starting a company, investing in a friend's startup company can be a simple way as well, or investing in large private equity firms. But private debt. I've seen racehorses. People have done, flipped racehorses in their retirement account. They flipped houses. Anything you can think of. Cryptocurrencies picked up a lot. Precious metals have been around forever in retirement accounts. If it's investable, we've seen it in a retirement account, but we tend to see a lot of stuff focused around, private equity, private debt in our division.
Yep, I like that. I'm just trying to think of the private debt thing. So loaning, being the bank essentially, and you can, if you're doing private lending, you typically want to be in the first position, and you can almost create your rate, right? Your interest rate to a degree. But I'm just trying to think of that because, like with cash value whole life insurance, we talk about lending like it makes sense because it's growing 3 to 6% in the policy. You lend at 10 to 12%, and now you're getting that spread on your loan. With this, if you're pulling money out of your IRA to lend it, you're not still making money in the IRA, correct?
Well, the money you make in the IRA is when you lend it. So it's really, Kyle's IRA is lending to Matt Calhoun at 10, 12%. So I'm getting that return back to you.
Yeah.
The benefit of doing the retirement account is outside the retirement account. So you take the loan and the life policy and lend it out. That income you generate, the interest income, is not in any way tax depreciated. Basically, you're going to pay taxes on that income. You do it in the retirement account, you don't pay taxes on it. So that's the benefit of doing it within the retirement account versus outside. Kind of getting in the weeds a little bit there, but no, it's a powerful tool on the debt side to lend out. But you can invest in a debt fund also. So if you don't want to be the one that's issuing notes out or due diligence on investors, you can have someone else lend the money out as well. So that's a way to do it.
Yeah, I love that. No, I'm actually glad you brought that up because you're exactly right. It's a tax play more than anything else. I mean, you're just getting that benefit.
Yeah.
So
correct.
No, I love that. Again, access to capital. It's out there. Your money's sitting somewhere and you can use it. And I feel like just from the wealthy that I've been around, they tend to keep their money moving.
Yeah.
They don't let it sit.
They don't be idle at all. And I always say it's a possible higher net return. So if you do two investments, apples to apples comparison in the retirement account outside, your return in the retirement account is a higher net return because you're taking out Uncle Sam as your business partner and giving him his cut. So that's kind of the benefit there as well. It's a better net return on the same investment.
That's great. All right, a couple more questions. So give me a downfall. Give me a negative to this? Like, say you put money in a real estate deal and it goes belly up and you don't get
Yeah.
that money back. Now what happens?
Yeah. So put the money in the real estate deal, it kind of works similarly if it's outside the retirement account, but now you have us involved trying to sign documents for you on your behalf. But if you have collateral or any types of stuff, great, that goes back to your retirement account. But if the deal just goes bad, you lost the money in the retirement account too. So it works very similar way.
Okay.
Yeah, if I had to like poke holes in some of the things, the benefit you get from investing in the retirement account goes back to your retirement account and not flows through back to your personal income. So this is one downside of investing now, is those tax benefits that I get on some of those investing. So oil and gas is a pretty popular investment that people do a lot of times for the tax benefits. It doesn't go back for your personal income. It goes back to your retirement account. So there's very few situations, but your retirement account could have itself a tax implication. That's kind of like a advanced course on for this, but so that's one downside, is it flows back to your retirement account, not to you personally. So if you're doing the investing just to offset your personal taxes, that's one downside of self-directed retirement accounts.
Nope, I think it's great though. I mean, it's a retirement account, so as long as you have the mentality to know that that money's staying in that retirement account, then you're good. Like, this is my future money.
Yep. So one other thing kind of comes up is certain transactions. This is what we're in place to do, is kind of put some guardrails here. Is there are prohibited transactions? So like self-dealing, buying your own assets, or like family members, like some of that's prohibited. You can't do that in a retirement account. That's, like I said, some of that falls on us, but we'll make sure it's aware that you can't structure deals in a way to get your personal assets. So if I already own a property outside my retirement account, I can't sell it to my retirement account to try and get that benefit. And who I can transact with is a little bit limited. So there's that. Although this as a positive, and I mentioned earlier that you can leverage in the retirement account as well, but that is a non-recourse loan. So you can't personally guarantee the loan that your retirement account takes. The positive side of that is you're not putting your personal assets on the line. It's basically just the asset that's in the retirement account, but it does restrict your financing options. If I wanted to go buy just kind of give an example of that, I just kind of threw out a lot of terms. If I wanted to go buy a rental property in my retirement account, I had 20% down to put as a down payment. I can do that. I could take out a loan. The loan is going to be issued to my retirement account only. I'm not putting my personal home as collateral, any of my personal assets. The lender is going to look at that deal, make sure it's a good deal for their balance sheet, make sure that the income supports the mortgage payments, everything else. If things go bad, the most they can do is take back that asset from the retirement account. So it does shrink the amount of lending options, but I just, bought a $100,000 property with $20,000 in my retirement account. So something I can't really do any otherwise. I did leverage and increase my purchasing power, but there are some downsides with non-recourse loans versus what you can get outside the retirement account.
Yeah. No, that's great. So, with this all being said, you've been around wealthy. You talk to wealthy people all the time. And, I say wealthy, just that mindset. I think, some physicians fit into that. But again, I think a lot of physicians just, unfortunately, we just don't have the knowledge. So we want to be wealthy. We just don't know how to get there. And so we almost need some hand holding. But what are some core principles that you see that the wealthy are doing that maybe nobody else is doing? What are some different like mindset shifts that they have, or whatever that is?
Well, a lot of times the job of physician or someone in the medical field, they have a job. They're good at something. A lot of times the wealthy that I speak to, their job is actually managing the wealth and making sure it's moving. Like you said, if I'm working shifts and taking care of patients, the last thing I'm thinking about is my money working right now, this second? But the wealthy are thinking that. So if you don't have the ability to do that, it's really about leveraging the team at that point. And the wealthy do this really well. They have they may have multiple. So we said you're one CPA, but like the wealthy don't have one CPA or one financial advisor. They have a whole team in place that kind of do this. And I think that's where the mindset shift comes in, is getting the right team around. If you're not that person who can spend all your time thinking about these things, get somebody who can, or have the team in place that can do that as well. Because you're right. The wealthy that you speak to and I speak to, they're very strategic about what they're doing, and they have the people in place that can help manage all these things if they don't have the time to do it.
Yeah, no, that's great. And, I think doctors have a hard time being like we always talk about, or not we, the successful people talk about, it's good to be the dumbest person in the room. You want to be learning from people much smarter than you. And I think doctors have a hard time with that because, ego, we're always the smartest when it comes to medicine,
Yeah.
but we're not when it comes to finances. And I think a lot of docs have a hard time with that. But being the dumbest person in the room is great. That's how you learn the most.
In the
And
right room. Yeah.
be in the right rooms. That's it. And
Yeah.
that's what we're doing with Doctors Investor Club, partnering with Family Office Club. Like those family office meetings, they actually have, you're not there because are you going to it?
Yeah. I'll be there. I'm there tomorrow. Yep.
Okay. So it's
Yep.
in Fort Lauderdale, a big investor summit. It's the biggest one of the year. And I was supposed to be speaking there. Grant Cardone's now keynote speaker, which I saw. But we have, 3 young kids at home, and my wife would rather me be here. But with all that being said, like I've actually tried to create my own little family office. I have, financial advisor that I've opened them up to all the things I'm doing. So we do, real estate and different things. But you have your, CPA, and to your point, maybe a team. You have your lender, the bank. You have somebody like you with Equity Trust. And, I try to put my guys all in the same like email and just try to create that like, hey, we're all doing this together, keep everybody on the same page. That's what family offices basically do. They have their whole team all trying to increase this person's wealth or maintain that person's wealth. It's a team sport.
Yeah, they all play their role, and they kind of get together and talk about the best way to accomplish it. Versus, like you said, that if I'm just kind of the retail financial advisor, I have my thing. I have my hammer, and everything kind of looks like a nail. But when you have a team involved, everyone kind of has some different perspective to provide there, and that's powerful.
Oh, I love it. So if somebody listening to this is loving what you're saying, they're like, oh my gosh, I have an IRA, I have a 401k, I want to start doing real estate, I want to do even crypto. I mean, you could put it in Bitcoin or something like that, right? But using that access to their capital, how do they approach you guys? How do the steps work?
There's a way to kind of do it very passively, go online and figure stuff out. But I always kind of recommend book a call with me. I always have my calendar available. I always say, let's have a consultation call, kind of figure out what you're trying to accomplish, see if this kind of works out, and kind of a plan in place. Like we move really quickly and efficiently. If you're just kind of feeling things out, at least it's good to get the info and kind of figure out the next steps are. But I always recommend that. Like reach out to me directly. Let's set some time, even if it's 15, 20 minutes just to talk, kind of figure out your personal situation, what you're looking to do. And I'll provide all my contact info as well, so people can reach me directly. There are good resources online. Like I said, when I first started, it was kind of hard to find any info. It's out there now, so there's a lot of podcasts. There's a lot of good online material. Our website has some good overviews to different asset classes and how to invest in them. But everyone's situation is a little bit different, so it's always good to have that one-on-one call.
Yeah, absolutely. Yep. And one thing I meant to ask, you may have touched on it, but so if I'm trying to start my own practice, private practice, cash pay, could I use a self-directed IRA to fund that?
Possibly the easiest route would be a ROBS 401k. So ROBS. We kind of currently have something that does it, but there are some groups who specialize in this, and it's a rollover business startup. You're essentially starting a plan that purchases all the shares or part of the shares of your company. So that is kind of designed to be starting your own business. You're investing in somebody else's business, definitely the self-directed IRA.
Okay.
If you want to leverage like a solo 401k, HSA, IRA account, I always recommend having a pretty good attorney who's going to be familiar with. We have great examples of people who have done it with their own company. So Peter Thiel is famously got his Roth IRA to purchase the PayPal, and Mitt Romney got a lot of flack for owning Bain Capital in Roth IRA. So it can definitely be done. If you don't have the attorney or the resources, I always say the ROBS is kind of just the easy way because it's built for that. But yeah, we can facilitate it as well. If you're investing passively, then there's no issue at all. We can set you up easily.
Yeah, not to get political, but you mentioned Mitt Romney, and you think of what the wealthy are doing. It's real estate. It's investing in businesses, things like that, or having their own business. But these politicians are doing the things that the IRS tax code is allowing them to do. And so if we as patrons complain about that too much, it's like, guys, don't take that away. Yeah, they're doing it because they're following the rules. We can follow the rules too.
Yeah, and if someone's not familiar, both have hundreds of millions to $1 billion in their Roth account, so tax free, and that's kind of where the publicity got kind of on it. But yeah, correct. They followed the same tax code that any of us are, and it's a lot of money in a Roth account that is not going to be taxed at all. So there's definitely ways to do it within your own company, but yeah, I would say you're gonna have a good attorney just to make sure it's all done right. I's are dotted, T's are crossed.
Matt, this is phenomenal, man. I really appreciate this. We have I always end with last 4 questions. I call it the pulse check. But before we get there, is there any final bit of advice you have to listeners, to doctors, residents, medical students, dentists, anybody listening to this? Any words of encouragement for them?
Yeah, I mean, if you're new, I would always say start saving now. Like it's amazing what just even a few years of saving and let that money compound and grow. And then yeah, if you've been doing it for a while, then let's start getting tax efficient at that point. We kind of hammered it home. We talked about it a lot, but I'll kind of say it one more time. Getting your buckets in place, being strategic about what that withdrawal looks like and that accumulation. So the accumulation phase, how we grow that money, and then how do we pull that money out the most tax efficient ways is really powerful. So.
Yep, that's awesome. I appreciate that.
Yeah.
All right, last 4 questions. What book are you reading right now?
So I'll switch a little bit because right now I'm kind of revisiting some fictional stuff and different things. But I am reading a nonfiction on Thomas Aquinas. So I'll say that's what I'm currently reading. I always recommend The One Thing. I think it's a Gary Keller book. I have a shiny object syndrome, thinking about, I should do all this stuff, and it always brings me back to what's the one thing that kind of moves the ball forward every day, and just focusing on that. So I recommend the biography as well, but the One Thing is a good book to recommend as well.
Yeah, we all need that reminder.
Yeah.
What advice would you give to your 25-year-old self?
Buy more, buy more real estate. It's always funny because you kind of get a lot of noise in every investing class and in the world, but in real estate, it's always like, we should have bought 10 years ago. Now's a terrible time. Don't do that. And then 10 years from then, you're like, man, that was a really good time to buy. We should have bought a lot more. So I definitely would have told myself to buy a little bit more, not be reckless, but just know, like, real estate has a funny way of making you look really smart in 10 years or 20 years. Like if people are like, wow, you got really lucky, or you must have been really smart that time. Sometimes you just buy and real estate does its thing.
Yep. That's great advice, man. Because, some people that get into real estate are like, 2 years. Oh my gosh, I'm not seeing the fruit of my labor. It's like, dude, give this time. This is something that compounds over a long time. This is a long-term game. So I like that. What's your personal definition of wealth?
So I wouldn't even really put like a dollar figure, because I think that varies for everybody, having a dollar. And if you came from money, it's a different number. So I always think it's that strategy of thinking multiple generations ahead. Once you're kind of in that spot where you're like, I have to get enough to get by, or living paycheck to paycheck, or not living, for the next year, it's really then thinking about, okay, how do I continue this wealth building for the next generations? I feel like that is where the mindset shifts to. I'm wealthy now, and not just trying to get by or just trying to accumulate for a certain goal.
Yep. Last one. Proverbs 11:25 states, "A generous person will prosper. Whoever refreshes others will be refreshed." If you could make one lasting impact by giving back, what would it be?
I just think knowledge. I think we think, finances for some people it's a game. Like you talk about, like, somebody that's their job or stuff. But for some people, it is their life. Like, they have to worry about where that next paycheck's coming from or something. Like, being able to provide that knowledge and just get people to not stress over, like, so much relationships are lost to money and different things. If we can kind of make that financial literacy better, to kind of just take that stressor off everyone, I think that makes a big difference. That's kind of my way of trying to get back, is just give knowledge whenever we can.
Yeah. Well, thank you. You did give us knowledge. And, I encourage you guys to reach out to Matt and his team to learn more about this stuff. So Matt, this was incredible. You did awesome. Thanks for empowering physicians to take control of their wealth, be more tax efficient, break free from traditional investing limits. Ultimately, where can we find you? We'll put your information in the show notes, but where can people reach out to you?
Yeah, email's always great. You have my direct phone number, so you can text me or shoot me a call. But I'm on LinkedIn a lot as well professionally. So if you see me on LinkedIn, that's a great place as well.
Fantastic. All right, we'll be in touch soon. We appreciate you.
Thank you.
This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time.
Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. Our mobile app and forum are free for physicians and dentists. You'll find AI tools, curated investor resources, and live events. And if you want VIP access to private dinners, exclusive deals, and opportunities to speak on stage, it's free when you refer 3 colleagues. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building legacy.
Watch out, here I come. This is my time. I'm on the rise. Can't hold me down, I'm too fly. This is my time. Ready to shine.